Greetings, it is time for our monthly quantitative easing update, and for further proof of how money printing up to a very high level does not cause any aberrant inflation, as I continue to prove every month, and each new month of data continues to bear out these conclusions that I have presented more than 5 years ago. So we go to our Yardeni balance sheet, linked in the description box below. These are the four major central banks of the world: the Federal Reserve, the European Central Bank, Bank of Japan, and People's Bank of China. The US Federal Reserve is in red. And as you can see, it's not even the largest money printer of the world. It is second after the European Union in absolute dollars, and at about 8.4 trillion comprises only about 1/4 of all the money printing being done by the four major central banks of the world. These four central banks do not comprise all of the quantitative easing being done worldwide, but probably comprise about 90% of it. Now, the only thing that matters is the worldwide total, because quantitative easing is borderless, so is technological deflation. That is why it is quite ignorant for people to say the Federal Reserve is printing so much money, therefore the price of gold will rise. They're relying on the central bank of one country, a country that does only 25% of all the world's quantitative easing, and saying a worldwide price commodity will rise. They're not even looking at the amount of money printing done by any other central bank. Now, if they saw that, they would see that it's 4 times more than just the US amount, so they would think that there was already hyperinflation, or in some crazy cases, insist that we have already been in hyperinflation for a very long time. But that is just very, very ignorant, and people have to go out of their way to not look at data to think that, because when we look at the grand total over here, quantitative easing began quite a few years ago, most notably in 2009 after the real estate bust and that great deep recession, because the Fed funds rate was already at zero by that time, and they needed to effectively simulate a negative interest rate, so they started printing money in the form of quantitative easing. The reason they don't call it printing is quantitative easing is convoluted and complex and creates the illusion that they will undo this printing at some point, and the economics establishment thinks they will undo it, but how many years has this been going on that they have just been printing more and more? Because under the atom thesis, we know that this money printing has to be permanent, has to be rising exponentially, and certainly can never be undone. And therefore, as of September of 2021, it has reached this amount, 30.8 trillion. They had stopped money printing in 2018 and 2019 only for the crisis to emerge to force them to get back to this trend line. Now, notice how this is a parabolic trend line, just like every other exponential technological and economic trend that we always see. Therefore, the amount that is being done is, in fact, almost exactly the correct amount. Now, what does this mean in terms of year-over-year percentage gains? Longtime viewers know that I say the proper band for monetary creation growth, for quantitative easing worldwide growth, should be between 16 to 24% a year. That would mean in this middle band over here. And for the most part, it has been somewhat below that band. The coronavirus crisis shot it up to 46% year-over-year growth. 46%, but that was temporary. That peaked in February. Now it's all the way down to September, and we're down to just 15.1% year-over-year growth. That's in fact slightly below what I consider the optimal band. So the chance of any aberrantly high inflation occurring is becoming less and less. Not only is the year-over-year growth rate moderating back down to normal, but the time since the growth rate was very high is becoming greater and greater. So as it gets further and further in the past, there's no longer any chance of some big blast of increased velocity of money that causes a temporary blip of inflation. We're down to 15.1% year-over-year growth in the combined balance sheets of those four biggest central banks, and that is absolutely within the normal band. In fact, slightly below what it should be. They should start edging it back higher to maintain it in the 16 to 24% band, in fact. So the fact that people say that quantitative easing is about to cause hyperinflation when it in fact has been going on for 11 years and there is no aberrantly high inflation, as I will demonstrate later in this video, these are people who fundamentally are unable to step out of the theoretical world. They memorized a model from the mid-20th century, and none of the data is corroborating what they memorized, and therefore they just double down and don't mind that they have predicted 100 of the last 0 bouts of hyperinflation. They don't mind being wrong. They are only communicating with each other in the economics establishment. So the economics establishment, comprising all these PhD in economics, really has no idea, because they only have groupthink and cannot account for anything in the real world. They are just the most hyper theoretical beings you could ever think of. Equally bad is someone who is an investment manager like Peter Schiff, who continues to predict hyperinflation all the time and it never arrives, and he keeps saying it's almost here, almost here, almost here, and therefore the response is to buy gold, which is another extremely bad investment thesis, as I debunk over here, as well as where I debunk Peter Schiff more directly over here. They just don't know about the economics of technology or the first principles of technology and economics, and therefore what connections between various events that might have been correct in the mid-20th century, they think those could still happen now. It's very analogous to when the mechanical engineering establishment in the year 1901 were certain that no heavier than air flying machines would ever be possible, until two innovators actually demonstrated a heavier than air flying machine, and now we have airplanes today. So this year-over-year growth rate is the one to keep up, and it also tells us how much printing will be done in the near future. To just do 16% growth from current levels over the next 12 months, so 16% on 30.8 trillion, over the next 12 months would be another $5 trillion of money printing. $5 trillion added to the wealth of the world without any aberrantly high inflation, because that is what is needed just to offset deflation and maintain an optimal level of inflation. And in closing on this chart, the other big thing of how the United States supposedly prints so much that we're going to have hyperinflation, this is a chart of how much each central bank has done as a percentage of their own GDP. Now, as we know, all of this is a worldwide number. If one central bank prints less and the other prints more, it makes no effect whatsoever on the actual world total. But the United States, the red line again, the US Federal Reserve, is actually the joint lowest of the four. The only one that's as low is China, and Japan is the highest. It's 4 times as much. Whereas the United States has done 30% of its annual GDP in cumulative printing over the last 12 years. Japan has done 130%, so more than 4 times as much money printing as a proportion of its entire economy. This is not a problem because printing is borderless. All the QE that Japan does just goes into the United States and China, which is why both of those two entities do surprisingly little, because they're drawing from Japan's QE. And nobody thinks Japan is hyperinflation, not even Peter Schiff, not even these PhD economists, not even the absurd Economics Explained channel, which I completely debunk over here. Nobody says Japan has high inflation, but they have printed 4 times as much money as the United States. Why? How can these people believe something that is so demonstrably inaccurate? None of the data corroborates their entire theory, and my framework is so simple and so elegant, and it's always continuing to be proven out. And in the future, more people will recognize this as such. But this is how much quantitative easing is being done. 400 billion was done worldwide in September of 2021, which is exactly the correct number. That is absolutely the proper trendline number. And I maintain that there is no aberrantly high inflation, nor will there be, because once you understand the first principles of technology and economics, you realize how all this interconnects. Now, what is the actual inflation data? For that, we go to part 2 of this video. So as usual, we go to the bls.gov website for the US CPI index and click over here to this little graph icon. And so we have the CPI data over here, and therefore among formatting options, we choose the following: original data value, 1 month, 3 months, and 12 months. Retrieve data. So this is the absolute value of the CPI over 10 years, and yes, it's rising because the natural state of affairs is to have average inflation. 2 to 3% inflation. The steady state is not to have 0% inflation. That is too low. That is going dangerously into deflation, and deflation is much worse than inflation, as I describe in this video over here. However, we do have inflation, and it is actually kind of low. It's a bit lower than the ideal and has been for the last 10 years. So while people are screaming about this recent rise, where does that reside in the context of the entire long-term moving average? And to determine that, we have to look at the average inflation rate over the last 10 years. So to do that, we take this calculator and we take this number of the CPI, 274, divided by the number from 10 years ago, 227. 274 divided by 227. 1.207, which means the 10-year total inflation has been 20.7%. But in order to find how much that is per year, we take the 10th root. So we take x to the y power of 0.1. That is to show the 10th root of that number to get the annual compounded rate. I hope everyone understood the arithmetic of how that is. And there you have it. It is 1.9% a year. 1.9% a year, 1.01899 or 1.9% a year is the average CPI increase rate over the last 10 years. This does not exclude food and energy. It does include food and energy costs. So 1.9% a year. That is in fact slightly below the band of optimal inflation, which is 2 to 3% a year. Now, as you can see from this 12-month percentage change, the 1.9% average that we see is kind of manifested, and it's a little high right now, but that's a very temporary thing. It's only offsetting the super low inflation from the early part of the COVID-19 crisis, and the average is still 1.9% a year. And this brief spike is already mitigating, and that's why I chose the 3-month moving average as well. This is the 3-month moving average. The spike that everyone was screaming about a couple of months ago, that's already dissipating. It's already getting down to the normal 3-month band, which is over here. So you can see it's going down. This scare of hyperinflation has already started to go away. And 1.9% a year has been the 10-year average, and you should always take a long-term moving average, like a 10-year average, so you're not swayed by all the short-term media hyping up of noise-level data. Even on this channel, a number of commenters asked me, well, I heard somewhere in the media that inflation is really picking up. Really? Really? This is called picking up? It's already going down from that point. The average has been 1.9% a year. But this is the US CPI, and this is a US only figure, and money printing is worldwide, as well as technological deflation being worldwide. There are no borders to these things. Therefore, as always, we go to the Goldman Sachs Commodity Index to get the true measure of inflation, because that is worldwide, reflected in commodity prices, and therefore not riggable. A lot of people say that the CPI is rigged by the government to understate inflation. Well, the Goldman Sachs Commodity Index cannot be rigged because it is an index of commodity prices that anyone can buy. Anyone can buy oil or gold or natural gas at the prices that they trade at every day, and the composite of those prices represents the Goldman Sachs Commodity Index. So we go there. Goldman Sachs Commodity Index, 591. It's picked up a little bit in recent months, but does that really matter within the 10-year context? Sure, over 1 year it rose 63%. That's huge, that's huge. That is hyperinflation because it rose 63% in a single year. But what did it do before then? The 10-year average is minus 0.75%. That is deflation. The price is actually lower than it was 10 years ago. And this is a composite of everything from oil to gold to natural gas to all sorts of other commodities bundled together. The 10-year average is minus 0.75%. So while the CPI has risen plus 1.9% over this 10-year period, commodities have actually fallen at minus 0.75% a year for 10 years. That is deflation. Despite this little uptick because of all the various factors trying to push commodity prices higher but failing to do so, people are screaming about this, but unless you're looking at this 10-year chart, you're not getting a holistic picture of all of the data. And this is the way to look at inflation. Now, for all the people who are either predicting hyperinflation or even worse, claiming that hyperinflation is already here, but using weaker and weaker rationales to justify that, all that is nonsense. We have exponentially rising technological deflation, and the money printing needed to offset that deflation is therefore also rising exponentially. And this is a good thing if it is recognized as such and recognized as a monetization of technological deflation for human benefit. And I wish more people could grasp that, but you have to have a very multidisciplinary profile of knowledge, and people who study economics just don't have that if they have a formal PhD in economics. They're very theoretical people. Their faith in their theoretical economic models from the mid-20th century is total, and evidence doesn't get them to change their mind, as we often expose on this channel. Now, as far as what level of inflation would be considered slightly high, see, I won't deny if there actually is high inflation. When that happens, I'll tell you if it's happening. But the amount of money printing and or bad government mismanagement needed to create that level is much higher than it is now. Bad government management being the bigger factor of the two in that scenario. So unless the CPI index's 10-year average is 3% a year, above the 1.9% that we just saw, 3% a year, and the 10-year growth rate of the Goldman Sachs Commodity Index, which we're looking at right now, is also 3% a year on the positive side, meaning it's green and plus 3% a year. Until both of those things happen, don't worry about inflation, you should be more worried about deflation, and how the very, very misguided approach from the Federal Reserve to actually end quantitative easing and raise interest rates, despite there being no reason for them to do that at all, is going to cause deflation, which then means they'll just have to print more later on anyway. So until the CPI is plus 3% a year, and the Goldman Sachs Commodity Index at the same time is also at plus 3% a year, over a 10-year moving average, I don't care about short-term fluctuations, 10-year moving average, only then should you actually worry about inflation starting to get a little high. It's still not at a problem level yet at those thresholds, but that is when we should say, okay, maybe things are edging a little high. Until that happens, I will not say that inflation has any risk of being very high, and the threat of deflation is in fact the thing to look at, because that's what no one is looking at all. Thank you very much for watching.